Average true range, ATR, is a technical indicator that shows the volatility of price over a given time frame. We have dedicated an entire chapter on this indicator, so you can find the link somewhere on the screen if you didn't watch it already. Now we are focusing on using ATR to calculate stop loss. The ATR can be useful in determining where you can place your stop losses when trading in markets that have different volatility levels. Since the ATR is quite a good volatility indicator, it can help to preempt traders for wider price movements, which is a characteristic of highly volatile movements. This would help traders know how much further away their stop loss needs to be when opening a position. As a general rule of thumb, when the ATR reading is high and thus volatility level is high, price movements will be wider than usual with greater spikes and dips. This gives us the signal to set stop losses further away from their entry price to avoid getting stopped out too early into the trade. Conversely, when ATR reading is low and thus volatility level is low, price movements will be narrower and a smaller stop loss can be used. This is similar to the function of the volatility stop, which is another common indicator used in technical analysis. In the chart, which shows EURUSD in the daily time frame, the ATR is showing an average movement of 73.1 pips a day. Here we have an image of the ATR of GBP/USD in the daily time frame, which is 123.8 pips. Comparing between EURUSD and GBP/USD, GBP/USD moves 1.6 times more than EURUSD. In other words, GBP/USD is more volatile than EURUSD, thus it's reasonable to assume we'll see much wider price movements. So, using a bigger stop loss for GBP/USD is much wiser when trading this pair as compared to EURUSD. A similar principle can be applied when using ATR to calculate where we should place our take profit levels. In a more volatile market with higher ATR readings, we could aim for a larger take profit in order to maximize this move. This is because you would expect the price to spike or dip more sharply in a more volatile market, thus you can aim to ride out as much of this change in price as possible. On the other hand, in a less volatile market with lower ATR readings, it would be better if the take profit level is adjusted lower. This is because you would not expect such dramatic spikes and dips in the price as you would if the market was more volatile. In order to catch the smaller rises and falls in price, you would want to put less of a distance between your entry price and take profit level. If this helped you understand how to adapt with real market volatility, make sure to like, subscribe, and hit the notification bell so you don't miss the next video.